Okay, let's take that story forward. Robert Schein is the CIO at Blanke Schein Wealth Management, joining us with his take on things. Robert, thank you very much for joining Evening Your Side. What's your own read as far as the Fed's decision is concerned? Because the market is almost going with the foregone conclusion. In fact, now it's debating whether it's going to be 25 or 50. But do you think that it's a done deal of 25 basis points in September?
I think the market's telling us that, and the fact that there wasn't a knee-jerk reaction by a major sell-off. So, Powell didn't disappoint. He clearly communicated moving forward that obviously they're data dependent, but this is the concern that I have moving forward. If the Fed's been data dependent, and we just had a 30% revision in the employment number of 818 jobs over the past 12 months, March to March, what kind of data are they actually dependent on, and how reliable is that data? So that's showing that the trend in the U.S., we've got a weakening labor market, which plays into a 25 basis point. But the question is, do they go 50 just to be precautionary and not to be behind the curve again? So, but I think 25 is baked in. The markets expected that. There wasn't a big sell-off. So that's where we sit today.
Indeed, indeed. And so what happens post the first rate cut, if it were to come by? Because now I think the question is also, what would the rate easing cycle look like? What would be the nature of that cycle? Would it be a shallow cycle? Would it be an intense one, an aggressive one? People are talking about 3 rate cuts this year and then more in 2025. And I wonder how that will get placed and spread out, given that till November we'd only be talking about elections.
Yeah, let's start with the elections, because if we go back to 94, 95, you had Clinton in the office, and Newt Gingrich came over with a divided House, which was setting up from 95 to 99, one of the best markets we've ever seen in market history. And the reason that was because we had a divided Congress, right? And that means that spending stopped. So that's exactly what we need. We had too much COVID stimulus. Obviously, it's working its way through the system, causing inflationary pressures and a lot of dislocations in the monetary system. So I think one of the best signs that we could be looking for in the elections in November in the United States is a divided Congress moving forward, because that means they stop spending, which is a big driver for our inflationary pressures here.
I understand that.
I was just going to say, as it relates to the pace and timing, the yield curve is showing 200 basis points for next year, between now and next year. So let's call it 2%, right? Fed funds is at 5.5, and the 10-year treasury is at 3.8. So there is a delta there that there is movement and some room for the Fed, but the Fed can just take it as they see it, as the data comes in. And then the elections could play in, like I said before, to help the Fed with regards to inflationary pressures, stop the spending.
So very quickly, Robert, this will not be that rate easing cycle where we see rates going down to zero, right? At the end of the day, a lot of market participants are saying that the Fed would be less restrictive than where it is right now, but that does not mean that they will swing the other way in being ultra dovish. So to that extent, maybe between 2.5–3% is where we would see terminal rates.
Yeah, we do not want to see, climbing the stairs and then an elevator down. The elevator down would indicate something severely wrong with the U.S. economy. So if we could have a measured pace on the way down on an easing cycle, that would be welcome for the economy. So maybe a soft landing. But the GDP is drifting lower. A lot of the employment's drifting lower. Inflation's drifting lower. So, yeah, they have a window of opportunity to thread the needle, but we do not want to see a 50, 75, or 100 basis point reaction, because that means that there's something else in the economy that the Fed would be worried about, and we should be too.
Got it. Robert, stay on with us. We'll be back with you in 2 short minutes and talk about his stock ideas. You have a few outlined for our viewers. We'll discuss those when we come back in a bit. We're back with Robert Schein from Blanke Schein Wealth Management. Robert, just because we touched upon China and the China story, and we're seeing a big sell-off in Chinese tech, I just want your view, broadly speaking, 40,000 feet essentially sitting out of the U.S., and how you're seeing this play out, because ultimately China is a big supplier to everything going into the U.S., and so there is that inflation link to China.
Well, everything's interconnected, especially globally speaking, and that kind of gives us sort of the picture preview maybe for what we will see later on with the AI giant NVIDIA in their earnings report on August 28th. But if you look at it, big tech sold off today a little bit, but I don't see that as a big concern. I think what we have seen this summer is a rotation out of big tech. It's been quite an amazing leader for the last several years now. But for us to see the markets continue higher, in fact, industrials, the Dow Jones Industrial Average today hit an all-time high, but tech sold off, right? NASDAQ was down. That's a positive because the market is now rebalancing, taking money off the table out of big tech and putting it into value. Think of the high free cash flow yielding companies, which is a good thing moving forward. We need to see that if markets are going to continue to work their way higher.
Right. Let's talk about your stock ideas. You like Eli Lilly.
Yeah, Eli Lilly has just been a dynamo. We believe it's going to be the first $1 trillion healthcare pharmaceutical company out there. So it's going to, gravitate to the tech space in the $1 trillion club sooner than we think. But more importantly, they just had another great release of a positive study. It's the largest and longest study, and it had 94% efficacy as it relates to those that are pre-diabetic, stopping them to becoming type 2 diabetic. Now it's heart health, obesity, and now you have, obviously this all around helping move the GLP-1s in the right direction, which opens the door for now Lilly and Novo Nordisk and all of those healthcare companies to petition the U.S. government to basically for insurance coverage and for government, Medicare coverage moving forward, because the evidence, medically speaking, is there that it will save billions and trillions of dollars in the healthcare system moving forward. That's one of the reasons why we like Eli Lilly. The valuation's a little rich, so you can sit down and wait for maybe Lilly to pull back a little bit. But, we believe the total addressable market of 226 million Americans just in the United States, there's room for even the competitors to come in, fill that void. But Lilly is still going to continue to do well.
Okay. We have a minute and a half to go, Robert. So very quickly, Microsoft and Berkshire Hathaway.
Well, Warren Buffett's Warren Buffett. Obviously, he, again, rebalanced out of his position, but it was a sizable position out of Apple. And now he has $276 billion on the balance sheet of just cash. And he has the ability of a war chest to go after and take advantage of opportunities. That's why we like Berkshire Hathaway, and they're up over 25% year to date. But Microsoft, again, relative to its peers, the valuation is a little bit rich. But if you look at the last 26 years of Microsoft, they've only been out of the top 5 of valuation at the end of the year in the top best 25 or 5 companies only one time, 2001. So it's an evolution story. They constantly have obviously hardware, software, cloud computing, and AI now as a driver. So that's why we like Microsoft for the long term as well.
Okay, super. Robert, lovely to have you on the show. Thank you very much for your time. Enjoy the rest of your evening.
You as well.
Take care.